It's trying to start the YouTube broadcast. All right. Let's see if this works. Welcome back, YouTube. Welcome back, Facebook. Welcome to the Forex.Today 2.0. I don't know what happened. My internet didn't drop. Nothing dropped. Nothing changed. It just stopped streaming, I guess, huh? Say something, I'm giving up on you. All right, so hopefully we see each other soon. Please confirm that you're here. Just because it's a new stream, the second version of the same stream. Let me start with a disclosure. It's just a requirement. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Say something, I'm getting up on you. Anybody here? Well, we'll just pretend you're here, and hopefully I see you soon. So what we were talking about is the government data. So I had this up, okay? U.S. import-export prices, right? There you go if you want to see it. So we were looking at that. And then I was trying to Spain it to you. So what I do is, if you're importing a product, you're exporting your cash. And that's what we're really interested in, because we want to see cash cross a border. And when cash crosses a border, it changes the value of the currency. So what we're looking at is, we imported 100 billion in TVs and cars and t-shirts and stuff like that. But we exported soybeans and beef and gold and diamonds and, Mickey Mouse stuffed animals. No, those are probably China. But anyways, we exported Mickey Mouse somehow. But that means we're exporting a good, but we're receiving cash. So you have to look at it as the same, only different. So in this case, when we have a trade deficit, which means we imported more than we exported, but that means we exported more cash than we imported, right? We exported $100 billion in dollars to import a product, but we received $80 billion for exporting a product. And at the end, we exported $20 billion in cash, which would then lower the value of the dollar. And of course, when you're bringing in more Mercedes than you're exporting Fords, it's a good thing. So the trade deficit in America, at least, is a good thing, because we have enough money, and because, relatively speaking, of course Forex is relatively speaking, foreigners earn lower wages than Americans, so we'll have them make us stuff, and we're fine with the decline in the dollar. We're fine with that. We're just cool with that. You're like, hey man, as long as you make me, right? Like, have you ever tried to buy a bicycle from China? Amazing what you can get. $200 in China for a bike gets you a $1,000 bike in an American bike shop. So if you bought it for 200, even less than 200, when I say 200, it could be like $150. That includes shipping it all the way. I mean, amazing what you can get. All right, no one has chatted, so I don't know if I'm live. Oh, you guys are over there. Oh, I see. Okay, you're over there, but I'm not getting a multi-stream read. Is anyone? Why would it? Yeah, this system is interesting. It's hopeful. There's some hope there. But oh, okay, now it's pulling up. All right, so I refresh it. All right, so the system's chunky, but I think if I can figure out its weaknesses, I could at least sort of tiptoe around those, and then I like the idea that we can communicate from more than one platform. So I ain't giving up yet, brah. All right, cool. So anyways, that's why I say, first of all, let me ask you this. Should you pay attention to import-export data? Yeah, because what does it tell you? It actually tells you the foreign exchange market. If we're importing, we're exporting dollars. If we're exporting, we're importing dollars. Because remember, if India buys something from America, we don't want rupee, we want US dollar. Okay? You got it? Money flow, that's right, on. Cool. All right, now the multi-stream is working. All right, cool. So let's take a look at what happens during a risk-off period to emerging market currencies. Okay? US dollar gets strong during risk-off. And when the dollar got strong, it bullied and overpowered the MXN. That's it. Okay? So dollar got strong. We don't know anything about peso, really. We just know the dollar's strong. Okay? So as traders now, we have to make our decisions. So let's check out, let's confirm. Okay, we're on daily. So we're at the daily sell zone, 121. Well, it's actually well above 121. Right in here, anyways, is what I'm trying to say. We knew yesterday that this would be a selling pivot. Now, we don't like this stretch, but that's that. I mean, you don't like it, but that's what's happening. Now, let's change and get a bigger point of view. Instead of daily, let's take a look at weekly and see where we sit inside of the weekly trade plan. Okay? Weekly swingers, we're supposed to sell it here, 121.5, and that's your Friday front run. So if it doesn't fall here, you should back off. Now the next technical, if you want to throw in price action, the next technical area is there. Now you add in another level of complexity, and I know you can. I would say the price action tells us bearish, but also look where we are. 2 standard deviations from the mean. Now, of course, you can incorporate more, okay? But my thought process, and I explained this, I think it was Euro-Yen yesterday, where we said, okay, you might be a bull, okay? You might be a bull. However, you should not buy dips in a downtrend. So you pick the time frame you feel comfortable with, and this, if you're using smaller time frames, you're aggressive. And as you increase your time frame from a 5-minute to a 15-minute to a 30-minute to an hour to a 4-hour, you're becoming less aggressive. Okay, which means if you use an hourly chart, it might take you a whole day to go from a bull to a bear, which means you have to give away a whole day. You might not want that, maybe you do. Honestly, it doesn't matter, especially if you're looking at a trend you're going to be in for 3 years. What do you care if you have to wait a day? Okay. Oh, I got a question here. I don't get it. What is risk on, risk off? Sentiment. Think of it as attitude. You're either taking on risk because you want to get reward, or you're frightened of something and you say, give me my money back. Okay? You're either deploying capital or conserving capital. Deploy capital, risk on. Conserving capital is risk off. Okay? Risk on meaning you're aggressive, you want to deploy your capital, you want to put your money to work, and you know reward is a function of risk. It's just calculus. Reward is a function of risk. The more risk you take, the more reward you demand. Okay? So if you are demanding profit, you have to deploy capital and accept the risk. Okay, so you're confident. And in the opposite, you say, you know what? Give me all my money back. I don't feel comfortable with this situation. And that's risk off. You're taking risk off the table. Okay? Now, again, on my Thursday group, we spent, probably 25 minutes, and I explained in great detail why the Japanese yen gained strength in that scenario. Okay? And people were like, that makes sense, right? Knowledge is power. Veritas. Steve, you got kicked out. That happens, man. The thing is, don't lose sight of your fundamentals. So again, this is what we talked about last week I know it sounds like a sales pitch, but it's honestly the conversation. We were talking about having a multi-year plan based on fundamentals and getting comfortable with the idea that it might be a week or two without a trade, but you also will be in the trade for months, if not years. Now, I'm not saying that's the only way to trade. It's a food for thought process. So you could scalp, and scalp this down and do whatever you need to do on a 1 minute chart, 5 minute chart, 15-minute chart, great. Hourly chart, 4-hour chart, great. Weekly chart, daily chart, great. Whatever. You should have a well-rounded strategy, right? In particular, if you're really good in the short-term charts and you incorporate fundamentals, which, your strength might be short-term, and if so, maybe your weakness is long-term, like the fundamental plays. Well, as you get better at both, so you practice your fundamental position trades, but you continue to do your short-term technical trades, the cool thing is your short-term trades are essentially hedging your longer-term positions, and you get this wonderful congruency where on the long run, you will do better if you're good at both, okay? Because your short-term shorts are offsetting your long-term longs, but also you will be short-term long with your long-term longs, and then your long-term longs are open, but when the market's down, you're also taking short-term shorts, which is an indirect hedge, or actually direct, but it's a smarter way of hedging. And at the end of the year, at the end of the decade, you'll be way, 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 way better off if you compared to only doing one or the other. You see what I mean? Yeah. So Steven says, didn't want to miss the boat. There were good trades and stuff. I'll remind you this, and you'll write this down now, okay? And go through this exercise, Steven, and it may help you in future years. Because I'm not saying like you should just ignore it, it didn't hurt or whatever. We have to make decisions as currency traders all the time, okay? Look at how the yen pairs opened for September. Many of them opened at exactly the price you'd expect downward movement. And we also talked about the fourth year of an 8-year political cycle. This is exactly the year I would not necessarily expect the yen trade, let's say, until closer to November, right? So there's like, I can see. And we're kind of getting what I would consider normal. Now, we were hoping for a big yen move, and we're hoping for fiscal stimulus to kick in, but that might still happen, right? And we have to prepare for the election coming up, and that may be a catalyst for yen moves, right? But we have a new government coming in, a new yen regime coming into place that we have to get comfortable with too. Like, there's a lot going on. And I've never said this year, like, just buy all the yen pairs in the third week of August and go home, right? No, this year has got multiple unique layers of complexity that only occur in the fourth year of an 8-year political cycle, right? So go back and look at September. Observe what you need to observe with the yen pairs, okay? The ones you got knocked out on. Look at them all. What was there? What was the story? And then put that in the context of the political cycle, okay? Not just annual seasonality, but now we're talking about a 4 and 8 year cycle, right? And then write it down and take notes so that you have something to look at the next time this occurs. That's the big thing, Stephen, right? Imagine it's, when will this happen again? Let's say Trump gets reelected, so then there's 4 more years. And then we get a new president, so that's 8 years. So 8 years from now, you might be in a scenario just like this. And you should be able to go back to your notes and say, okay, what happens? Okay? For example, I told you guys to take notes, and this was maybe last year. I said things like, they're called contingency plans, and at some point you should have a binder of these things. Like the next time there's a massive earthquake in Japan, you should know exactly what to do. And you need to be fast. The next time there's an earthquake in Chile, you should know exactly what to do. Okay? You should start writing all these things down, right? Okay? But don't get upset, Stephen, right? That's the killer, and we talked about this maybe back in February or March about this 4th year of the 8th year, political cycle and how it's going to impact the yen and all that. And my number one advice was it's probably going to take longer than you expect, and it's going to potentially break your confidence, and that's the real risk. Okay? You need to put the plan into perspective. I think a lot of people just come in and say, oh, Wayne said this last year, so that's what's going to happen every year. And they simplify it down to not properly reflecting reality, where there's more layers of complexity every year, but that's the basis of a bias, but you still have to do your technical and fundamental analysis inside of the general plan. You understand, right? Like it's never so, if it was so easy, then we'd all be rich. Right? Yeah, Moreno's frustrated with the pound. Yeah, well, and of course now we're back onto the whole Brexit thing, right? So anyways, going back to this, the question was, what is risk on, risk off? So I answered that. Risk off, dollar gets strong. Another way of looking at it is investing into Mexico is a risky investment for an American. American can choose, invest in America, okay, or invest in Mexico. In the last, couple of hours, people have said, you know what? Give me my money back. And the flow has been up and back toward the United States of America. Now, it might be just one standard deviation from a mean, and that's what we're measuring here. Okay? Now, if you want more data, if you want to be more conservative, you would adjust the algorithm. And you say, well, over a larger period of time, like a larger sample, right? You can increase your data sample. Hang on, I was doing the calculations. It's a lot of math. Yeah, and Guy's on it. Like Guy's at the next level. Guy's like, it's supposed to be going up. Okay. Now you look at this and you say, well, on this time period, 233 is too much. Okay. But on this time period, it seems reasonable, right? So the last time we were in a statistically speaking, the last time we were in a scenario like this, there was upward movement. Okay? Now, as Guy pointed out, if you measure the market, so I'm measuring price right now. If you measure the market, it's supposed to be reverting. If you're measuring price on this time frame, 233 4-hour candles, and we suggest the last time we were in a statistically similar situation, it did revert. Okay, and you got to remember the mean is in here somewhere. Okay, there we go. Okay. Okay. And we can show that by maybe oh, no, that's fine. Bias pivots, monthly, and true. Let's make this true. I'm giving up on you. Okay. Now, using our other technical analysis, now let me get rid of this stuff. These were like the short-term prices, right? Let's get rid of that. We're not interested. Get rid of that. Not interested. Okay. The other thing is Guy points out, because Guy's on another level. He's on another, not just a different time zone, a different dimension. A bearish profit zone. It's supposed to go up, fellas. Okay. So what we did to calculate that was look at last month's high, last month's low, last month's close to get a weighted mean. Divided that by 3. And you got the central pivot. Okay. And then you look at the high and the low and create a standard deviation. And then you, right, so let's do this high and low. It's not really, this isn't the actual math, but it's not like H plus L. It looked, I guess you'd kind of do it like this, right? You'd look at the high, comma, the low, and say how high is the high from the central pivot, how low is the lowest low from the pivot. That's how far it deviated, the standard deviation. And then you do 2x of those to create, right, 2 standard deviations, which is 95% of price action, as you know, so 2 standard deviations. And then you look at the midpoint between them, okay? So you do S1 plus S2, okay, and divide that by 2, and then you look at R1 plus R2, divide that by 2, okay? So what does this get you? This gets you your M2, your M3. No, that's your M4, isn't it? And that's your M1. And then you do that for the other pivots, whatever. And you can see it's just math. It's just statistical analysis of a data set. And we call this the market because it's what happened in the last period. So we created support and resistance of the last market. And then I filtered out most of this data and said, well, if you were a bear, what's most important? Okay? And what we said is, statistically speaking, you would be selling here, see, bearish sell zone. And if so, based on the statistics, this is where you would take profit. And we knew this in August. Now, we're also sprinkling a little pixie dust on here. Typically in September, we go even farther, and you would have to do S2 plus a standard deviation to get to an S3. And that would be way down here somewhere, but maybe the psychological level of 20. But that's outside of the math. The math doesn't tell you that, okay? What the math tells you is sell here, okay? And look how specific it is, 22.17. And it says to get out at 20.9989. Oh, snap, right? Isn't that interesting? So these pivots, these price pivots that I've done for you are doing kind of the same thing. It's looking at how low price tends to go above the average, which is the central pivot, how high price tends to go above the central pivot, right? Actually, let me do this. And it creates, right? It creates a standard deviation, which represents 60. Oh, let's thin this out so you can see this better. Which represents 68% oversold and 95% oversold. And then I create a zone. Okay. So if you were a bear, it says you should probably consider not selling anymore. And in fact, if you were expecting some up, you would take your profit right here. Okay. Now, this is 68% oversold. It's actually probably 75% oversold right now. And it could go down as much as 95% oversold, but that's your call. All we know is somewhere in here is pretty reasonable to expect to revert back to the mean. That's why they call it a mean reversion. The price pivots are not on MetaTraders yet, but I will give them to every customer that has signed up. I will give it to you for free. Does that sound fair? I'm also thinking about starting, I tell you all this the time. I spent time this morning thinking about the book club. Mahai says, why didn't we just use linear regression? You totally could, right? Absolutely, 100% correct. Mine will update as you go. So as price turns north, it's constantly, every candle is calculating a new rise over run, right? Rise over run is equal to the slope. Slope is equal to M, right? And the measurement that we're doing, if you guys remember, right? Y equals mx plus b. Okay? And so it's calculating all of this in real time, right? The y and x intercepts. Well, the y-axis, the x-axis, the slope between the two, and the intercept. Okay? It's doing all this math in real time. So you could sit here and say, well, let's say you want to buy this pair. Or actually, I did this yesterday when it came to euro yen. I said, you might be a bull, and we're at a bullish buy zone. But I said, you don't buy lower lows. How many people remember this? How many people remember this? I said yesterday, I believe it was euro yen. And I went through it from a bullish point of view. And then I said very clearly, it's not something I would buy. I'm a bull. It's at support. I don't care. Now that's difficult, right? And what I said is you could wait for the market to statistically turn bullish first, then you buy the dip. You see what I mean? Oh, Brian says it was pound yen. Okay, thank you, Brian. But you see what I mean? So now I can statistically wait for the data set to show me the rise over run is a positive number. That's all it is. And at the point I said it was a negative rise. It's a negative slope, but I'm a positive bull. So now I can wait for the market to statistically, both measuring market or measuring price, ideally both, before I decide to get on with it. And this is where being a short-term trader and being a long-term trader is fantastic, because you may see technical setups that are still bearish and you're like, oh dude, bro, I gotta sell this. I mean, this is clearly gonna fall, right? And meanwhile, the bulls are sitting around waiting for the reversal. So bears still are in charge. So you can make money until all of a sudden as a bear, you'll know, because your bearish trade will fail. You either break even or maybe you even lose money. But then you're like, aha, I've observed it now. On the time frame I was measuring the long-term long, it is now bullish or expected to go bullish. So now you can stop being a bear and start tiptoeing into the longer-term long trade, and now you're getting the best of both worlds, right? You can have the steak and the salmon. And you're like, shut up. You're like, wait. Okay? So, best of both worlds. Okay, best of both worlds. Best of both worlds. Another thing we kind of talked about is if the dollar's strong, the euro's weak. So, Rand is even stronger than euro. Isn't that amazing? Okay. So these are day trades. You probably should be looking at it for more like a, oh no, those are weekly swings. All right. And I ran position trading bearish. And you look at that, you had a millisecond to catch that. Had a millisecond. Look at that. Sick. Hard to believe in the moment, but it's happening now. So what do you do with that? I would start folding in like I just did, go from monthly to weekly. Start folding that in and say, okay, you missed this, and it was legit but hard to believe, especially after a move like this. So what do you do now? You set up next week. So here's what's supposed to happen this week. You ready? I'm going to put it a little above that. And then it's supposed to go here. And between, what day is it? Tuesday? Yeah, it's Tuesday, right? Between today and Thursday, you're going to want to short around 1964 to 1971. And you might say, well, why not just do it now? Because you'd be a fool. Okay? You don't sell at support. I don't sell at support. So you'd have to wait for a break and a retracement. The other thing you can do to help you is you open this up and you put the conservative target on too. Okay. Oh, and I did pretty good on my guesswork. Cool. So now you got down, 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 up, up, market sell, price action sell. Okay. And now you trade it through. Okay? So now, if you want to look at it at yet a different way, you can day trade it. Okay? Okay? And you can see selling at 1963 is supposed to be tomorrow's trade. But what will happen is you'll sell it here and it'll come all the way down, right? You see what I mean? So now you got this up and down into here. So now we're looking at it kind of probably closer to this. See, we're refining as we dive in. Okay. Okay. And now you can draw into a smaller time frame. Okay. And you keep adding layers of complexity. Okay. You can see it's easy to tell that there's a negative rise. So, however, a bear should be expecting a positive change because we're at the right price to expect that. Okay? See, you don't want to do it there, you want to do it there. Okay? It rises from 1950 up to 1963, okay? And then what? That's where you'd expect to sell. What do you think? Can I get a like? Would you click the thumbs up button? That's a lot of statistics, right? That's a lot of statistics. A little bit of calculus. Mostly statistics. I guess it's all statistics leading to calculus. But anyways. So now you wait. You just sit and you wait. Let's look at confluence. Okay. That's not confluence. Maybe if I just change the time frame. Oh, I must have clicked the wrong one. Okay, cool. Okay. So to put this into context, like someone else said, why is it falling? Why is it falling? Well, one way to explain it is this is the September selling pivot. This goes back to Stephen too, right? I said, take a look at how September opened. Okay. Last week, this was the selling weekly sell zone. This week, this is the weekly sell zone. Okay. And what you have is multi-time frame step downs. Okay, so this is the monthly part. Let's see if I can do this in a way that makes more sense. There's too many lines for, I think, a lot of people. Okay. Okay, we'll call this monthly sell. Okay, cool. So now we can get rid of the monthly pivots. Which one is it? It's the other one. Okay, cool. Cool. So that's the first step. The second step is weekly sell. I know I misspelled that. Who cares? I want to move on. And then you do here, weekly sell. Okay. And now isn't that interesting? Seems logical, doesn't it? So what you can do is you sit and wait for the market conditions to be favorable. Remember, during Sunday's webinar, our Off the Charts with Wayne McDonald's Forex Traders Social cocktail party, one of the things I talked about was, what was it, Diamond Point Capital Management or something? Every few years they buy something. Every few years they buy something. And they make minimum $70 million a year. And that's how hard they work. So like to sit and wait for market conditions, you're like, wait, that can take 2 or 3 weeks. Yeah. And other people do something every 2 or 3 years. Can you imagine? What'd you do this year? I recruited clients. What'd you do? What's your plan for next year? Recruiting clients. When are you going to trade? Oh, we don't really do market timing. Of course, you definitely do market timing. But amazing though, right? Isn't that amazing that people do that? That's the kind of money they make. 2 guys and some staff have to live on $70 million a year. Plus their performance fee. That's if nothing happens. And of course, they mostly do nothing. It's crazy, right? So anyways, this is falling hard and fast. We knew this week was going to be quite fundamental. And ideally, what I'm hoping for is this is setting up my buy. I'm a bull. I want it to come down. I want to buy it cheap, but I want to know that the bears have exited. That's why I'm adding to another dimension here. I have to wait for bullishness. And the first step, well, it's not even bullishness. I need bearish profit taking. So that's why I insert this to say, let's do it this way. Is it bullish now? No. Okay. Is it bullish now? No. 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 You know what, I haven't done it before and it just popped into my mind. Insert, indicator, custom, biased pivots, bullish mode weekly. And I'm going to put, I went too far. No, I didn't. True, midpoint, true, okay. Bullish, oh wait, the colors are off, right? True, where's the colors? Misty rose, gross. Anyways, I'll put it there. So I started bullish first, right? And then insert indicators, custom. I haven't done this before. Let's try it. Bearish mode, weekly. Oh, it won't let me do it. Ha 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 ha. Won't let me do it. Won't let me do it. That's interesting. That's smart. That's good. I guess. Thank you, Marina. I appreciate that. And I'm very glad that you're of your success. Also, I hope you see that I've taken your feedback seriously. So there we go. Look at that, huh? On this time frame, we are 2 standard deviations from a mean. I think what we really want to look at is this sort of area and this area. Well, I guess it's the same thing, isn't it? So what I'm hoping for between 124.77 and 124.00, I get permission to go long for at least 100 days. Thank you, Mr. US 30. Appreciate your viewership. And of course, these don't line up. I hate that about MT4. They never line up on multiple time frames. The interesting thing about a Mr. US 30 is the whole time we're talking about what to do next. So I'm not sure what you're talking about, bro. Okay. I want to mark out the next support zone. I don't think we're going to go that low, but you know, like I said, it always tends to break your spirit before going up. So I'm going to kind of mark this as a reminder for myself. Joe's been studying commodity super cycles. Very interesting. That might be a good thing to read for our book club. Which reminds me, I got to do something. Okay, cool. I'll get back to that later. Oh, is that right, Geek? Yeah, let's take a look at that. I wanted to pay attention to the commodities as well. So thank you for bringing that up. Here's Bitcoin, by the way. How did I do? Doesn't look like hindsight to me. I got a question here. What do you think about the Fed interest rate decision FOMC press conference? Will the market react to the news or no major changes expected? No major changes expected, but it will move the market. Not everyone's on the clue train yet. Okay. That's right, Mahir. I'm waiting for risk on dollar weakness, so we probably have to get through tomorrow's meeting. Let's go through. Here's gold, by the way. Apparently more hindsight trading where I have this up, 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 down, down, buy, up, up, up. Well, it went a little higher than I thought, but it hit the zone, down, down, buy, and now has gone up. So there you go, USD 30. And the one I didn't see coming is the collapse in oil. But I did put a price on it. Okay. This, this one I didn't see coming at all. That's a pretty aggressive move down, and I was trying to figure out where it came from. No, Robin, lots of hecklers today. We drew this in advance before it happened, days before it happened. We drew this days before it happened. I spent 20 minutes explaining how and why, and then we got to break through, and then when it breaks through, it's got to hit a top, and then it's got to come back, and then it's going to be a roll reversal, and then it's going to go up, then it's going to hit a target, which is going to be a 618 off of a shoulder here, which could be, particular early in the week would create a reversion back to the central pivot point, so which they did. Then there was a breakup, pullback, took it down to the next level, which was likely a monthly pivot. So we had that as an exit zone. Here's the Monday entry, but in this case it's a down. So you want to see the double bottom first, which would create the higher high, which would create the higher low, which would put you in a swing trade up into here. There's going to be profit taking now, and then a dip back to here, and then up. So let's talk about this. Typically, if you hit this on a Tuesday, you actually have a bigger pullback. So that almost would predict something like this. Okay, so when I use this trend line tool to draw things out, it's because I'm drawing it into the future. Okay, now I got to be careful of this part here. And I think I prefer more risk on, so I'm going to do it this way. I actually want this to go up, not because I like Bitcoin or dislike Bitcoin. It has nothing to do with Bitcoin. It has more to do with dollar and risk on. I want this to go up, right? Well, no. So, wow, you guys are funny. Like, the person's like, well, plan A and plan B. I don't say plan A and plan B, it goes up or down. I say plan A, right, is buy it here. No, so I guess I should do this, right? I say plan A is to buy the double bottom. Plan B is to buy the roll reversal. I don't say plan A is to buy or plan B is to sell. That doesn't make any sense. So you're depriving yourself, Goldfinger. Okay. I think people that log in every day, they know exactly what my bias is. There's no like, why does he hide his point of view? I think everyone that attends for every day for more than a month or two knows exactly my outlook for every single pair and every single commodity. I don't think there's any illusion of what's going on. So if you don't know, then you're not asking questions. You're just showing up and heckling. Which makes you a wee man. Yeah, no. I am. I was just trying to figure out what I want to do next on this. You know, euro dollar is interesting too because it's such a canary in the coal mine. So, so I can tell you, like the Friday front run market open trade is here. So many of you swing traders are going to be in this price zone, and this sucks, right? For you, it sucks. You're like, this sucks. Because we're also facing this. So bulls have likely already entered. Bears have already likely entered. So what we do know is bulls are looking for this to hold. Man, I keep changing the color and it won't change. There we go. Bulls are looking for this to hold, and they don't really want it to go down to this price. Okay? So bulls really want this to hold, and then we're going to look at it to, you know, this kind of stuff, but that doesn't feel likely in the moment. It doesn't, in the moment, it doesn't feel that way. It feels like the giant sucking sound of a range, right? So I got to filter a lot here because there's like this going on, and then there's this going on. So this tool, like I said, that we're developing, and I'm getting used to using it, but also getting used to teaching you how to use it. This may come in more handy to keep you focused. So you can see, statistically speaking, if you're a bull here, you would remain confident in your analysis. You don't like that you're at the mean, but you're just at an average. Marina, though, they might want a signal service, but I bet you anything they don't have $50. So. Yeah. Okay. So anyway, so I look at this and yes, right. So this is euro dollar. I don't know why there's no watermark. Okay, this is euro dollar. Let me ask you, am I a bull or a bear? I don't know. I don't know. Am I a bull or a bear? Yeah. Thank you. So do I buy it here? I'm supposed to be in it already. Do I buy this giant red candle? No, maybe. I'm more interested when it's oversold. Not like this is almost like the fair value, right? Kind of thing, like the expected value. Not fair, but expected value. If you said this is the mean, then that's the expected value over time, right? So, I mean, we could put a ray on this. It's not really how it works. I think it'll allow us to ray it, right? Will it ray? Will it do the ray? No ray? Yeah, okay, that's fine. It wouldn't have, doesn't make that sense. Yeah, no ray. Okay, so you would expect this over time. And it's not like a guess, and it's not a prediction. It's just the math. Statistically speaking, if the rise over run stayed the same, over the course of time, we will get there. So is this a buying opportunity? This could be, but this would be better. But I'd rather it open low, right? I'd rather it open low than come all the way back to 18. But right now, I think what I'd like to observe, and this is now critical, now you have to put your listening caps on. What I'd like to observe is on a smaller time frame, the up now off of the 1850, right? Not on a 4-hour, but maybe on a 15. I'm not actually expecting it, but it could happen, and then I would have to respond. Or it comes down here and does the same thing, and then I observe the rise over run on the small time frame. Okay. Wayne, by the way, you misspelled my last name, Wayne Hindsight McDonald. I'm not kicking you out. My moderators are kicking you out. In a wholesome conversation, it doesn't start with, you're a loser, scumbag, liar. That's not a conversation, right? If you said that to someone in a bar, you'd get punched. So anyways. Cool. So, right? So now we have a little bit of a strategic plan here. So now you drop into this on a 15-minute chart or a 5-minute chart, and you wait for the rise over run to be positive. Okay. By the way, it's crazy how people can create YouTube accounts so quickly. Cool. Okay, so you see, here we are predicting the future now. Plan A is to buy it here if the rise overrun turns positive on a 5-minute chart, sitting at a midpoint psych level on top of a monthly central pivot in a short-term uptrend with positive fundamentals. Plan B is let it fall to 18, which is a full psych level, buying pivot in a moderately short-term uptrend into something that should be fundamentally up long-term. And when we get here, or if we get here, which isn't wanted, but probably will happen, then we still have to watch the rise over run turn up, which tells us statistically we are now buyers in a market that had just turned bullish, in a newly up market on a small time frame, which on a longer time frame may start making its own swings. And even that Elliott wave knows that. Okay? The rise over run is only M. That's the M of that equation. Okay? You see, guys? That's all future. That's either going to happen now or in Asia, most likely. And I'll catch the Asia fade. Yeah, what is rise over run? It's slope. Okay? So think of it this way. You take the average price, right? The average price over time. So this is calculating the average price. The average price of this candle plus that candle, the average price of the 3 candles divided by 3, the average price of 4 candles divided by 4, the average of 5 candles divided by 5, and you'll see each time you get a different number, right? So you might have one that looks like this, and then the average price of 3 might look like this, the average price of 5 might look like that, and then you get red candles, so then it changes slightly this way and then slightly that way as you add more candles. Each time you get a different average. So now imagine your average looks like this. Instead of just candles now, you're plotting the average, okay? Each time now, the rise over run is how much did this average rise over that average over the period, the time. So you have candle 1, right? What's the distance between candle 1 and candle 2 average, right? Over the period, so over 2. So it's the average and then the slope of the average, right? And then the slope after 3 and the slope after 4. So you're changing, you're adding up periods. So what I'm doing is I'm saying, look at, let's say like this, I think is 54, right? On 5 minute. Look at every 5 minute price, so a close price. What was the first one? What's the second one? What's the difference? And over the period. So period, right? So the difference, let's put this into maybe the difference of the average, I guess you wouldn't do it that way. You do it this way. The price average, that's supposed to be a P, 1. Wait, no, it's the other way. 2 minus the price average of 1 over you wouldn't use period, right? Over what, time? I guess you'd do time. If that makes more sense. Because price and period, right? 2 P's. So price 2 minus price 1 over time, it gets you the differential, right? So anyways, you're doing this, doing this, doing this, doing this, doing this, doing this, and you're coming up with all these averages and over the time period, right? And that gets you the rise. So if the rise is positive, then price went up over the period. Here, right? And then up over the period, then up over the period. Okay? So you're measuring this way and this way. Rise. So how much did it rise? This is rise now. Over run, which is this distance here. You see what I mean? That's what rise over run is. So if it's positive, the average price over the period was up. Because every time we added a candle, it went up above the previous average. If it's negative, a negative rise, like it is now, you're adding all this up, and it's a negative rise. So for every time period now, so now I have to draw it this way, okay? For every time period, so we're still measuring time. Over time, the run is always left to right, okay? Over, right, the rise was down. Okay? The rise was down, so you have over the period of time, the average price got lower and lower and lower, so it's a negative rise. It's a fall. So it's not predictive, it's analysis. Right? Statistics predicted, statistics predicted President Hillary Clinton. Statistics doesn't tell you jack. It's math. And what's important is your data set. Okay? Because I can tell you like, oh, if I don't like that outcome, I'll change the stats. Oh, President Trump's going to win? Oh, let's adjust this then. Let's adjust this to 233. Oh, now it's got to do the math. Huh? Look, it's actually doing the math. That's how complicated my indicator is. It's a lot. There's a lot of math in this. Wait for it. Okay, there you go. Now, Hillary's going to win. Woohoo! Right? Or Trump's going to win. You just change your data set. You're like, oh, we don't like those numbers. We need to change the numbers. The algorithm doesn't care. The algorithm is measuring what you tell it to measure. You don't like the outcome, you change the measurement. You change the data set. Okay? So I'm on a 5-minute chart and I'm looking to buy now. Am I aggressive or am I conservative on this point of the plan? I'm at the price I want. I'm on a 5-minute chart. Am I looking to be aggressive or am I looking to be conservative? No, aggressive. My plan is conservative, but if I've made a decision that I want to buy at 1850, then I'm looking at it either on a 5-minute chart or a 1-minute chart. I'm hot to go, HOTTOGO, ready to fire the trigger. How much am I going to risk if I buy it here and put a stop there? 25 pips? Okay. I could take the next 5A cross if I wanted to. It's approximately 68% oversold with a positive slope on a 1-minute chart. Now, that could be too aggressive, but that might not be too aggressive for you, right? Let's say you have lower leverage, or you typically only risk 25 pips, and you typically trade 10 times a day at 25 pip risk each versus one person making 2 trades a day or at 125 each. You're doing the same risk, okay? And so this is just another shot. Might be another shot, might be another shot. Someone else might say, well, I get what you're doing, but I'd like to see it happen on a 5-minute chart first, okay? So 1, 2, 3, 4, 5, right? You need 35 5-minute candles. 34 5-minute candles, right? 34 times 5. Okay? You have to wait 170 minutes. So you have to wait an hour and a half, basically. You see? Even on a 5-minute chart, you got to wait an hour and a half. Which means you're trading the London close. Which means if you observe that around the London close, all the bears from London took profit and they're out. And that's exactly why you want to do this. Now, if it falls lower, I don't turn a bear. So for the hecklers that come in, they're like, oh my God, he says he's bullish and bearish, and either way he's right. No, I've never once said that. You must be deranged or low IQ. Because what I say, I'm a bull here or I'm a bull here, and now I have to sit and wait. So I'm all about the future. But there you go. Cool. So yeah. So to wrap this up, actually, I'm still thinking about the book club. I think I'm gonna run it on the FX Bootcamp YouTube channel. So please get on that. I'm down to I need 150 subscribers over there, and it'll unlock some features. What I'm looking at first, and if it becomes popular, I have a big vision for this. But let's start small and digestible pieces, right? What I'm thinking is we take a vote on, let's say, 5 possible books. Like someone's reading one on super cycles. Shoot, maybe that's one. So we do a poll, a vote on a book 60 days from now. And once we decide, let's say, that gives us 45 days to order the book, to get the book, and to read some of the book, or if not all of it, right? So maybe for a week or two, we collect a bunch of votes, and then we decide on the book, and I say, so today is September. So November's book is XYZ Trading, right? And we all voted on that. So now you got to order it, get it, and read it, okay? Meanwhile, we're talking about the book we've already ordered, received, and read, okay? And so we all as a group read the same books and then come together and discuss maybe chapter by chapter, theme by theme, whatever. We can now discuss the book as a group. And maybe some of you, as you're reading, would be willing to do like a book report or something, right? So we could have on, let's say, any given book on trading, investing, Forex. Imagine after a couple of years, we have every book has like 10 or 12 book reports, like really thought out, well-written essays, if you will, on the most important books. So, right? Can you imagine that? And then we meet as a group and discuss it as a community. And then if we become powerful as a group, because, whenever we decide on a book, 1,000 books are sold or something, then we can go up to authors that are launching their books, through Wiley Publishing or self-publishing, and we can bring them in first, get advanced, at least maybe I can get an advanced copy or something, and I could interview the author about what they wrote and their trading philosophy and their background, and how they got there and all that kind of stuff. I think it would be great. Okay? Yeah, Daniel Patty, maybe. Yeah, maybe. Okay? But I need 150 more subscribers at the channel there. Okay? Now we can make a very complicated version where we trade the books. But anyways, we'll keep that for another thought. So cool. What's going on? Nothing's right, I'm told. You're a little late. Okay. Yeah, you'd have to buy your book. A-Rod says most YouTubers don't read and they don't want to put in the time to read the book. Good, don't join. So one of the things I'll do to filter those people out is I'm going to charge a small fee. Right? And they don't have $1 a day, for example. Right? Yeah, we could do, I love audiobooks and stuff, but what we'll do is we'll filter people out. 99% of people on YouTube don't have $1 a day. So that will filter them out. Right? Oh, you can grow as a human, as a person, and you can be in a great collaborative group with intelligent people with similar thoughts. Oh, it's $1 a day? Forget it. Right? Like, good. So that's what I'm thinking. And we can do some neat things on with that. So imagine, again, we could have all this great collaboration and especially on the fundamental side, like we could do trader. There's lots of great trader psychology books. I think everyone needs to read, right? But then we could do like yield curve analysis type books. That's how I learned yield curve analysis. I read a book on yield curve analysis. So we could pick out some of those. Super cycle books and all that kind of stuff could be very interesting. We could learn, we read books on Bitcoin. We could read books on gold. Just really, 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 get sort of the breadth of your knowledge big. Because remember, if you decide to launch your own fund, one important thing is how you are able to woo a client. And if all you know is like, oh, I only know some charts and some pivots, I mean, that's not what clients want to talk about. So if you have this, breadth of knowledge of the industry and of investing and trading and global economics and all this kind of stuff, it could just be really fascinating. Certainly, I don't think it'll hurt you. A-Rod says, have you read Millionaire Traders? That's the one by Boris and Kathy, right? And they found out 1 or 2 of them were fake. 2 or 3 of them were fake. But here's the thing. I haven't read any books. I haven't actually read. When I first started trading Forex, the only book available was Forex Made Easy. Which ended up being, if you're not even familiar with that, let's say non-legitimate. So I'm completely self-taught. So I'm interested, not really in trading techniques, because I'm just not interested in other trading techniques, but I'm interested in other sort of methodologies, thought processes, analysis techniques, and then sort of the breadth of knowledge stuff. I'm interested in trader history, so a lot of the trader psychology stuff, or like that book about the stock trader in like the 100 years ago, how he got into trading stocks. What was his name? That kind of stuff. The history of trading, the way that other markets work. So sort of like the mechanics of the markets, all that kind of stuff. I'm like, awesome, totally interested in, right? The mystery of banking, as long as they're not like the dollar's worthless, it's the end of the world, Bitcoin's going to change the world, money is fake. There's a lot of books like the hype books I'm just not interested in. Market Wizards is a good one. I think a lot of people need it. Oh, it explains the banking system? Yeah, cool. Yeah, I love banking. Okay. So anyways, and I'm not an expert per se in a lot of those subjects, but my economics background, my finance background, my alternative investing background could lend some helpful discussion to the books that we're reading. And then if we do create a powerful group and I can get the authors to come in, maybe I can ask some intelligent questions that get them to really open up and we can learn from that, right? You see what I mean? Yeah, like Trading in the Zone is one. Oh yeah, the Livermore one, thank you. Yeah. So like those ones, those are probably ones that we just Reminiscence of a Stock Trader, I think it's called, right? So, yeah, there you go. Boom. Daniel type it. Yeah. So, yeah, like those ones, for sure. We should read as a group, but we'll put it up to vote, right? So imagine now you're always ordering, every month you're receiving a book that you ordered 2 months ago, and this month we're reading and discussing a book, and then we're also voting on the book to order that you'll receive 2 months ahead, right? We're always ahead that way. I think it could be fabulously interesting. I already miss Harvard. In fact, it's funny though, right? I'm going back to Harvard next month, but I already miss it. I want to stay intellectual. I want to stay learning. I want to stay interested. I have been my whole Forex career, but you can easily become a grumpy old man that knows everything and everything else is stupid. And I don't want to be that guy. Everything I do, I like. I'm not trying to change anything, but I do want to stay inquisitive. Okay? I want to stay inquisitive. I want to stay open-minded. I want to stay inquisitive and interested. Otherwise, you become obsolete, right? Yeah, so Marina says, I only read your book, so why don't you start with that? Yeah, I that's where I thought I would start, just because it just makes sense, right? Most people already have it. And I can go back, and to me it'd be interesting to read my own book, because a lot of water's gone on under the bridge in 12 years or whatever it's been, right? It would be a hard book to read for me, though, personally, because it's an honest book. And I had to open up I had to let a lot of demons and skeletons out of the closet, right? But it'd be interesting to go back and see the young me. But I wonder if it's like a movie actor watching their own movie and they're like, oh, I never watch my own movies, right? Or if you've ever listened to your own voice, you're like, oh, I don't like my own voice. It might be one of those things, but it might be cool to go back and talk to the old Wayne. It might just be, I mean, it's a logical sense, Marina, so I think probably. Okay? And is $1 a day reasonable? I think so. Cool. So, but whatever. So I need 10,000 subscribers. I have 9,800. So, youtube.com/FXBootcamp. Subscribe. That's free. And we can always do whatever I'm doing free, like Off the Charts with Wayne. But YouTube will unlock where you can have a premium service on YouTube. Bear in mind, they keep 33% of it. So, right. But we can use that to then create a sub-community that can access that part of FX Bootcamp, which would be the bookstore. Not the bookstore, the book club. Okay. Cool. Well, thank you for being on my team. Thank you, YouTube. Thank you, Facebook. Thank you for being here. Peace on earth. May the pips be with you. May your profits be above average. And thank you to Traders Way. TradersWay.com. Go to TradersWay.com and open a demo account today. Boom. Snap. Bye-bye.